Ever wondered how to make money legally but in ways that seem illegal? Well, buckle up, because today we're diving into the intriguing world of legal money-making schemes that may raise an eyebrow or two. This curious realm is packed with ventures that, while appearing to skirt the law's edge, are completely within its bounds. We're about to reveal 5 such schemes, each one more fascinating than the last. We're going to delve into the details of each scheme, discuss what's required to make money, and understand why they seem illegal. More importantly, we'll clarify what could potentially tip these schemes into the realm of the unlawful, because while we love a good money-making venture, we certainly don't advocate for anything illegal. So, are you ready for a journey into the lesser-known but entirely legal side of money-making? Good, because we're just getting started. Stay tuned as we unveil the first scheme on our list. Starting our countdown at number 5, we have high-frequency trading. This financial strategy is as fast-paced as it is intriguing. High-frequency trading, or HFT, is a method used by financial firms to trade stocks, bonds, and other financial instruments in fractions of a second, using advanced algorithms and high-speed data networks. The basic concept is simple: buy low and sell high. But in the world of HFT, this happens at blistering speeds, often in less than a blink of an eye. This is where the role of technology comes in. Supercomputers and advanced algorithms are used to execute thousands of orders at lightning-fast speed, often outpacing traditional traders. Now, you might be wondering, why does this seem illegal? Well, it's mainly because of its secretive nature and the advantage it provides to those who can afford the technology. It can feel like the financial equivalent of a rigged game, where the fastest players snatch up the best deals. However, what would make it illegal? If these firms used insider information or manipulated market prices to make a profit, that would cross the line into illegal territory. But as long as they're simply using speed and technology to spot and capitalize on market trends, it's all above board. In essence, high-frequency trading is like a high-speed game of chess, where the fastest and smartest players win. The key is speed, precision, and the ability to make decisions faster than the competition. It's a world where milliseconds can mean the difference between profit and loss. While it might seem like a shadowy corner of the financial world, it's important to remember that high-frequency trading is not inherently illegal or unethical. It's just a different way of playing the game. And like any game, it's not the method that's questionable, but how you use it. So, there you have it. High-frequency trading, a high-stakes, high-speed financial strategy that's as legal as it is controversial. While it might seem suspicious, high-frequency trading is completely legal when done right. The 4th scheme on our list is a popular online business model, dropshipping. Now, what is dropshipping? It's essentially a retail fulfillment method where a store doesn't keep the products it sells in stock. Instead, when a store sells a product using the dropshipping model, it purchases the item from a third party and has it shipped directly to the customer. So, as a dropshipper, you're sort of the middleman, connecting customers to products. But here's the kicker: you never see or handle the products. You simply pocket the difference between the wholesale price and the retail price. Sounds suspiciously easy, right? This is why it might seem illegal. You're selling something you don't own and never have in your possession. It's as if you're selling air. But here's the thing, it's completely legal. The reason it's legal is that you're basically providing a service. You're connecting buyers with sellers and facilitating a transaction. You're not deceiving anyone or selling counterfeit goods. You're just leveraging the power of e-commerce to make a profit. However, there are ways that dropshipping can cross into illegal territory. If you falsely advertise products, sell counterfeit or stolen goods, or deceive your customers in any way, then you're breaking the law. Also, it's important to note that while dropshipping is legal, it's not always easy. It requires a keen eye for products that will sell, the ability to market those products effectively, and excellent customer service skills. Furthermore, it's crucial to work with reliable suppliers. If they fail to deliver, it's your reputation that takes a hit. But if you're able to navigate these challenges, dropshipping can be a lucrative business model. It allows you to start an online store without investing thousands in inventory. Plus, because you don't have to deal with physical products, You can run your business from anywhere with an internet connection. Dropshipping, when done ethically, is a perfectly legal way to make money. The third scheme that we will be discussing is exploiting tax loopholes. Let's dive into the often misunderstood world of tax loopholes. Essentially, tax loopholes are gaps or oversights in the tax laws that allow individuals or corporations to reduce their tax liabilities. They make money by keeping more of it in their pockets rather than handing it over to the taxman. Now, why does this seem illegal? The answer lies in perception. Many people view exploiting tax loopholes as a way for the rich to dodge their fair share of taxes, creating a sense of unfairness. However, it's crucial to understand that using tax loopholes is not a clandestine operation. It's simply a matter of understanding and utilizing the tax laws to one's advantage. So, what would make it illegal? In one word, fraud. Misrepresenting your income or expenses, creating fictitious deductions, or hiding money and assets could land you in hot water. While tax loopholes themselves are legal, using them to deceive or defraud the government is not. Therefore, it's vitally important to understand the tax laws before jumping into this scheme. Having a good tax advisor can help you navigate the complex maze of tax regulations and ensure you're not crossing over into the realm of illegality. Using tax loopholes may seem unethical, but it's not illegal when done within the bounds of the law. Coming in at number 2, we have flipping real estate contracts. Now, you might be wondering, what's that all about? Well, it's as intriguing as it sounds. Flipping real estate contracts is a strategy where an individual, let's call them the flipper, secures a purchase agreement for a property without actually buying it. Instead, they sell the contract to a third party for a higher price. The flipper makes money off the difference and never actually owns the property. Sounds like a sneaky way to make money, doesn't it? Now, why does this seem illegal? Well, the idea of making a profit from a property you never own can raise eyebrows. It seems like you're playing with someone else's money, and that's where people get suspicious. But here's the catch. It's not illegal. The flipper is essentially playing the role of a middleman, connecting sellers with buyers. However, to keep this practice on the right side of the law, full transparency is crucial. The original seller must be fully aware that their contract may be sold to a third party. What would make it illegal then? Misrepresentation or lack of disclosure. If the flipper conceals their intention to sell the contract or deceives the seller or buyer in any way, that's when it crosses into illegal territory. Flipping real estate contracts can seem like a scam, but it's actually a legal practice when done correctly. And finally, the number 1 scheme on our list is penny stock trading. Imagine walking into a casino, putting a few coins into a slot machine and hitting the jackpot. That's the allure of penny stock trading. But unlike a casino, this isn't gambling, it's investing. You see, penny stocks are shares of small public companies that trade for less than $1. They're considered highly speculative due to their lack of liquidity, large bid-ask spreads, limited following, and disclosure of information. Now here's how it works. An investor buys shares of a penny stock at a low price, hoping that the price will go up. If it does, the investor then sells the shares at a higher price, making a profit. Sounds easy, right? But don't be fooled. Penny stock trading is a risky business. While the potential for high returns is attractive, the chance of losing your entire investment is equally high. So why does it seem illegal? The answer lies in its association with pump and dump schemes. In these schemes, fraudsters artificially inflate the price of a penny stock by spreading false or misleading information. Once the price has been pumped up, they sell off their own shares, causing the price to plummet and leaving other investors at a loss. But here's the catch. The act of buying and selling penny stocks isn't illegal. What makes it illegal is the manipulation of the market with false information. As long as you're trading based on legitimate information and not trying to manipulate the market, you're in the clear. Despite the high risk, penny stock trading is entirely legal. It's a game of high risk and high reward. But remember, with great reward comes great responsibility. Before you dive in, do your due diligence. Research the company, understand the risks, and never invest more than you can afford to lose. Penny stock trading may seem like a gamble, but it's a completely legal money-making scheme when done responsibly.